After a rough year in 2022, stocks have been on a tear through 2023 and the first part of 2024. Now, that has brought the stock market to some very expensive valuation levels. The question is, should you take an expensive stock market into account for your retirement planning? In this video, I'm going to walk through just where current valuations of US stock markets are at, and then talk about how you might adjust your retirement planning around these valuations. My name is Scott Caulfield. I'm a CPA and a CFA charter holder and the founder of Sophos Wealth Management. So let's start by looking at where is the current US stock market. One of my favorite things to look at comes from Advisor Perspectives. Used to be this guy named Doug Short who put this out. He would take 4 different valuation metrics and average them. Now, all the metrics are basically telling you the same thing. The US stock market is trading at some of the most expensive levels in history. So when we look at these 4 averaged together, you can see they are currently 146% over the long-term historical average. In fact, the only time stocks have ever been more expensive on these metrics is 2021. So at these valuation levels today, the market is more expensive than 1999. It is more expensive than 1929. And I think that's really important to note because those were, really poor periods for those with retirement assets. 1929 stocks went on to lose almost 86%. 2000 to 02 stocks lost 50%, nearly 50, and the Nasdaq lost 80. 2021, questionable if it's fully played out, but stocks had a rough 2022. So I think one of the important things when looking at, what do these high valuation levels mean? And I will caveat by saying valuations on average over the last 30, 40 years have been much higher than they were in the long time period, going back to 1900. So it does appear maybe there is a structural shift to a new higher average. But even within that structural shift, where valuations are today, it appears that we're probably at a cyclically high level as well. Now, what does this actually mean? I really like this chart, comes out of Crestmont Research, and it shows another valuation indicator. So that's going to be the orange line, and it says, that's just showing you once again how expensive are stocks. Now, this one I think was through the end of 23, so it's higher today. It's more like 34 on that right-hand side there, the orange line. So on this valuation metric, market is not as expensive as it was in 1999, but it's getting close to those 2021 levels, and it's still more expensive than every other period except for 21 and 99. Now, the green bars on this chart show the future 10-year returns. And the key takeaway here is that when stocks are expensive, the orange line is high, your future 10-year returns are much lower than average. In fact, in some cases, 29 and 2000, they went on to be negative over 10 years. So I think the adjustment that you would think about at these sort of valuation levels today is to expect future U.S. stock market returns to be far below average. Instead of 9 or 10%, close to that historical nominal average, you might expect somewhere all the way from 5% down to possibly negative over the following decades. If that actually came to pass, that would have a severe impact on your potential retirement, your investable assets. So how can you adapt or adjust your retirement plans for these expensive stock market valuations? The first kind of obvious answer is to adjust your asset allocation. So if you can be dynamic or tactical, stocks are expensive, let's own less stocks. Let's own more attractive alternatives. Now, this might be easier said than done. What metric are you going to go by? How much do you reduce it? It can be hard for, I think, the vast majority of people to actually gauge whether stocks are expensive or not. Most kind of retail investors I've seen just kind of do it by a squishy feel, which may or may not be very accurate. Now, I do think, though, at extremes like this, it can be very valuable. I mean, I don't need to be able to tell you somebody's exact weight, to be able to tell you they're at an unhealthy weight. I feel kind of that way about the stock market. Now, I do have things that I think help me kind of dial down how expensive the market is, like those average of 4 valuation indicators we looked at before, things like the Q ratio, but no one ratio is perfect, and they are subject to change over time. And I think the reality is, if as an investor we want to have a lot of humility, there's probably a pretty big range around normal where we don't really adjust your asset allocation. But when we are this extreme and our future expectations for returns are this poor, I think making a big adjustment makes sense. Based on those numbers we looked at earlier, it looks like short-term treasuries are probably expected to return more than stocks over the next decade. So to me, adjusting away from US equities and going into things like short-term treasuries, more international equity exposure, seems like a pretty intelligent move, at least for the intermediate term. But again, this is going to be really dependent on your own situation, whether you can actually execute this. For a lot of people, probably a more realistic thing that you should at least do is update your retirement planning assumptions. So, a lot of Monte Carlo type simulations, if you use fancy retirement planning software, let's say you've got an advisor, they're running a bunch of simulations, mostly around what historical asset returns have been. For US stocks, they're often going to plug in a number around 9-10%. Clearly, that's probably not a good assumption with valuations where they are today. Far too aggressive. When the market's expensive, it's just hard to expect those future returns to be at these levels. I mean, more things can happen than will happen. It is possible, but I would not make that a base case assumption. In fact, I would bring the sort of base case way, way, way down. Another way to go about this, I really like doing safe withdrawal rates when I'm doing retirement planning. Bill Bengen famously came up with the 4% withdrawal rate, safe withdrawal rate. The idea that if you can get your portfolio, your retirement, liquid assets, withdraw 4% of that in your first year of retirement and adjust that for inflation going forward, that has never failed in historical US markets. So 50% stock bond portfolio with a 4% initial withdrawal rate has never failed in the US. And in most instances will last 35 to 50 years. He even updated that if you do some sort of different asset allocation to a safe withdrawal rate of 4.7, 4.8%. But that's based on the historical data. Again, we're at really expensive valuations today. So if you were using a safe withdrawal rate, you would potentially start with a lower rate. In fact, Morningstar has done some work around this, and they came up with a safe withdrawal rate when they looked at it in 2021, and they used some different assumptions. They were looking forward projecting returns. I think they took into account valuations, but they're not really releasing the exact methodology on how they did it. In 2021, the safe withdrawal rate they came up with was 3.3%. It was that low in part because of how expensive stocks were in 2021 and how low bond yields were in 21. They updated that in 2023. So not at the end of 23, but partway through the year in 23. Stocks were not as expensive as they are now, but still expensive. Their update put it actually at 4%. And again, that was driven in large part by higher bond yields, allowing a larger withdrawal rate. So Bengen's actually, he's come up and said 4.7, 4.8% nowadays, but he would reduce that a little for current valuations as well. Again, you just want to take these into account with your planning. If you were using a 5% rate, and you're looking at these kind of starting valuations, that might be way too aggressive. You can always spend more in retirement. It's far harder to cut back. So, I hope this has given you some food for thought as you look at your retirement planning. I think we are just at one of those really extreme moments, and it can be wishful thinking to say, oh man, I'm just going to avoid a huge drawdown. I'm going to avoid a 2000 to 02. I'm going to avoid an 08, 09. There are people who've done it, but you can never exactly time things. If you get real defensive now and the market goes higher, yes, you're going to leave returns on the table. But if you can avoid a huge drawdown, that can be hugely helpful. Or if you can just update your assumptions, which might mean you need to save more in the future. It might mean that you need to cut back spending to get your withdrawal rate kind of in the acceptable zone. And then if valuations do correct, your portfolio is able to stay somewhat intact, you can kind of get more aggressive. So always happy to talk about your financial situation, retirement, withdrawal rates. Go check out my website for more information, and I would appreciate it if you like this video and subscribe to my channel. Thanks a lot.